Today, the Great Credit Crunch. Welcome to the Property Imperative Weekly to the 12th of May 2018. Hello again, I'm Martin North from Digital Finance Analytics. In this week's review of the latest finance and property news, the evidence is mounting that we are entering a credit crunch driven by tighter lending restrictions and the recent revelations from the Royal Commission. And the implications of this are profound, not just in terms of the immediate impact on home prices, but also, and perhaps more significantly, on the broader economy. Housing and finance for housing has formed a significant plank in the trajectory of the economy over recent years, and when coupled with construction activity, it has supported the transition from the mining boom. But now that could change, and the impact on households and the broader economy is potentially profound, as borrowers deal with massively higher debt levels and the inability to spend as a result, and also that new loans are going to be harder to get. And as a result, home prices will fall further and harder. Let's look at the evidence. First, there is a strong relationship between auction volumes and home price growth. This is why we watch the auction results so closely, as you can see from this chart from Domain and AMP, looking at trends in Sydney. Now, we know that there's a lot of noise in the system because of the way auction volumes are reported, and for more on that, watch our separate video, Auction Results Under the Microscope. But CoreLogic reported that the auction volumes fell last week. There was a total of 2,311 auctions held, which returned a final clearance rate of 62.1%. Over the same week last year, the clearance rate was much stronger, at 73%. Melbourne's final clearance rate has been fairly stable over the last 3 weeks. Last week's final clearance rate came in at 63.7% across 1,144 auctions, compared to 63.9% the previous week. This time last year, the clearance rate was 77.5%. And Sydney's final auction clearance rate was 63.1% over 797 auctions last week, after falling to 55.8% the previous week, which was the lowest clearance rate recorded across the city all year. And the clearance rate last year was 73.8%. And across the smaller auction markets, Canberra was the only city to see an increase in auction volumes, with 102 auctions held, up from 92 the previous week. And clearance rates were varied, with Adelaide, Brisbane and Perth all recording lower clearance rates week on week. Of the non-capital city auction markets, Geelong returned the highest final clearance rate at 75%, but only across 58 auctions. And CoreLogic are expecting lower auction volumes this Saturday, with Melbourne the busiest city at 1,012 auctions being tracked, and Sydney 696 auctions, down from 797 last week. Lending criteria are now tighter, with a focus on real expenses supported by evidence. Now, why this was not happening previously is a whole other discussion, by the way. Our household surveys reveal that more households simply cannot meet the current new and tighter borrowing requirements. Borrowing power has been reduced significantly. For example, in one scenario, take a household with an income of close to $200,000. Previously, they might have been able to get a $1 million loan, but now, if they provide more detailed expenses, including the fact that they pay for childcare, their borrowing power will now be scaled back closer to $650,000. And most lenders are applying stricter criteria, although we see in our data that the non-banks are still being more flexible, but the lending tap is being turned down significantly. And it's already impacting the ABS housing finance data to March 2018. The trends are pretty clear. Lending is slowing. And bearing in mind our thesis that lending and home prices are inextricably linked, this signals further home price falls ahead, which will be exacerbated by even tighter lending standards that we think are coming. You can watch our recent video, The Absolute Link Between Home Prices and Credit, for more on this. And remember, debt is still rising faster than inflation or wages. So household debt will continue to rise from its already overextended levels. The rolling 12-month trend says it all. And we see that both owner-occupied and investor loan flows are slowing, with investor lending shrinking faster. And you can watch our separate video on the data. Housing credit goes into reverse. The proportion of investor-led flows slid again, excluding refinance, to 43.6%. Now, CoreLogic did a neat piece of analysis showing the strong correlation between home prices and investor property lending. They said that since macroprudential measures were announced and implemented by APRA, the trends in housing-related credit have changed remarkably. Soon after APRA announced the 10% annual speed limit for investment lending in December 2014, investing housing finance commitments peaked at 55% of mortgage demand, and investment credit growth moved through a cyclical peak rate at an annual growth rate of 10.8%. Around the same time, the quarterly rate of home value appreciation peaked in Sydney and Melbourne, the two cities where investment has been most concentrated. As credit policies were tightened in response to the APRA limits, then loosened as lenders overachieved their APRA targets, the housing market responded virtually in concert. Interest rate cuts in May and August of 2016 helped to support a rebound in the pace of capital gains. However, as lenders came close to breaching the 10% limit, at least on a monthly annualized basis, credit once again tightened, and the second round of macroprudential announced in March 2017 saw credit availability restricted further. The result of changes in credit availability has been evident across most housing markets, but is very clear in Sydney and Melbourne. Dwelling values started to track lower in Sydney from July last year and peaked in Melbourne in November last year. And the latest trend in home price movements shows further falls in Sydney and Melbourne. In fact, from the start of the year, only Brisbane has shown any increase. All other capital cities fell with an average of 1.26%. And this before the tighter lending standards have been really starting to bite. But of course, whilst we see some slippage now, this is small beer relative to the average gain since May 2012, which is 46.7%, with the strongest gains in Sydney at 60.9% and Melbourne at 43.8%. But others are now revising their forecasts on future home price momentum, with SQM Research downgrading their estimates for Sydney, Melbourne, Brisbane, Darwin, Canberra, and the capital city average. They have tended to be more bullish than some other analysts, but gravity is finally catching up. And they also said that property prices in Sydney and Melbourne are massively overvalued against fundamentals by up to 45%. And we agree. UBS also published analysis that suggests that home prices are likely to fall on the back of weaker credit, as shown by this chart. Once again, gravity will win. You may remember the RBA warned recently of the potential for credit availability to become more constrained.
It's also possible that lending standards in Australia will be tightened further in the context of the current high level of public scrutiny on the banking industry.
And economists are all now beginning to highlight the potential impact.
If we think of what APRA and the RBA are trying to do, and the Council of Financial Regulators, they're trying to put their foot on the credit fire hose, if you think of it in that terms, and so trying to put a squeeze on credit going into the housing market and household sector, and try to ease things more gently, which economists would typically associate with the recession. That there's too fast an adjustment that comes through a change in lending standards, or that global capital markets stop funding a country or a banking system.
The question now is, how tight will lending become? Will the regulators try to alleviate the impact, for example, freeing up property investment lending again? And will the next move in interest rates be up or down in the months ahead? And more importantly, if lending tanks as we expect, then the spillover effects on the broader economy, growth, home prices, all compound the problems. We are in for a credit crunch. So my scenario 2, see our video on 4 potential finance and property scenarios, none good, if you want more information. And if you want more evidence of the economic indicators, then look at retail turnover from the ABS this week, which showed further evidence of the stresses on households. Retail turnover showed no growth in March in seasonally adjusted terms, following a 0.6% rise in February. Our preferred trend estimate for Australian retail turnover rose 0.3% in March, following a rise of the same in February. And compared to March 2017, the trend estimate rose 2.6%, and across the states there were some significant variations, with New South Wales up 0.3%, Victoria up 0.5%, Queensland and South Australia up 0.1%, Western Australia was flat, the Northern Territories up 0.3%, and the ACT up 0.4%. And this is consistent with our Household Finance Confidence Index to the end of April 2018, which showed that households remain concerned about their financial situation. This is consistent with rising levels of mortgage stress, as we reported recently. The index fell to 91.7, down from 92.3 in March, and this remains below the neutral 100% setting and continues the decline since October 2016. And you can watch our separate video, Household Financial Confidence Takes Another Dive, again, if you want to see more on this. Again, we continue to see little on the horizon to suggest that household financial confidence will improve. Currently, we think wages growth will remain contained, and home prices are likely to slide further, while the cost of living pressures continue to grow and households get into ever more difficulty. Whilst banks have reduced their investor mortgage interest rates to attract new borrowers, we believe there will also be more pressure on mortgage interest rates as funding costs rise, and lower rates on deposits as banks trim these rates to protect their net margins. And in the last reporting round, the banks were highlighting pressure on their margins as the backbook pricing benefit from last year ebbs away. We got, for example, half-year results from Westpac this week, which were an interesting counterpoint to recent announcements with stronger net interest margin, including from Treasury. And although CET1 ratio fell a little, they still said they were well placed. Mortgage delinquencies were a little higher, and they have been able to lift margins by reducing rates on some deposits, although they did signal higher funding at the moment and the risks of higher rates ahead. They defended the quality of their mortgage portfolio. And one slide in the investor presentation said Australian mortgages performing well. The data showed that Westpac originated around $5 billion of mortgages in the first half of 2018, or about $10 billion if you average over the year, or the same as the bank funded back in 2014. Now, if you compare that with the $18 billion in 2017 and the $17 billion the year before, momentum is clearly slowing. Analyst UBS, who called out potential liar loans at the bank, said that they remain concerned with the findings of APRA's targeted review into Westpac's mortgage serviceability assessments, and in particular comments from Wayne Byers, the APRA chairman, that Westpac was, to quote, a significant outlier, and Westpac's board papers, which stated its performance was poor, both absolutely and relative to peers. Further, Westpac stated in the March quarter around 20% of their loans were approved with a debt-to-income ratio of more than 6 times. And this is very high, especially given the concerns that mortgage or gross household incomes appear to be overstated across the industry. And the total debt position of customers is not yet fully visible because the mandatory comprehensive credit reporting won't start until July 2018. And you can watch our separate video, Westpac and the liar loans incident. CBA reported their Q3 unaudited trading results with a statutory net profit of approximately $2.3 billion in the quarter and unaudited cash net profit of $2.35 billion in the quarter. Now, this is down 9% on an underlying basis compared with 1H18. And we see some signs of rising consumer arrears and a flat net interest margin, which is in stark contrast to Westpac. Expenses were higher due to provisions for regulatory and compliance, and I think their reputation is in question. And the impact of reputational risk is highlighted by AMP's Q118 results. They said that cash flows were subdued in Australian wealth management, but there was continued strength in AMP Capital and AMP Bank. In fact, AMP Bank's total loan book was up 2% to $19.8 billion during the quarter. Their portfolio review of managed for value businesses continues, and in response to ASIC's industry reports, AMP continues to review advisor conduct, customer fees, the quality of advice, and the monitoring and supervision of its advisors. And they anticipate, they said, that this review will lead to further customer remediation costs and associated expenses, and they'll have to provide a further update at or before the 1H 18 results. This will include enhancements to AMP's control frameworks, governance, and systems. AMP's share price has fallen significantly to levels not seen since 2003, and in a vote of no confidence, Australian Ethical has announced that it will completely divest from AMP following the revelations of systemic, prudential and cultural issues at the Royal Commission. They will not reinvest until AMP demonstrates that they have addressed their underlying issues. And they said they're also watching 2 of the other 4 major banks, as they have holdings there, in the light of findings from the Royal Commission. Finally, it's worth looking at the impact of higher interest rates on the market. The Bank of England made small adjustments from a low base recently, and the results have been negative and predictable. The UK economy remains in the doldrums, so no surprise the cash rate remained unchanged this month. And in fact, the small rises made before have translated directly to lower home prices, reflecting the highly leveraged state of many households. In addition, GDP is expected to grow by just 1.75% per year over the forecasting period. Household consumption growth remains subdued. CPI inflation fell to 2.5% in March, which was lower than expected. And indeed, Fitch Ratings says that the UK household sector's worsening financial health reduces consumer resilience to income or interest rate shocks and presents risks for consumer loan portfolios. Consumer credit has been a key driver of rising household debt, but weaker household finance reduces the resilience of consumer spending, by far the largest demand component of UK GDP, to shocks. And a major interest rate shock appears unlikely, they say. They forecast the base rate to rise gradually to 1.25% by the end of 2019, but a more immediate shock could come from tightening credit supply. And they also said that the impact of the Brexit referendum on real wages may have faded, but Brexit uncertainty creates risks of a bigger shock to growth and employment. They say that UK banks are highly exposed to UK households, but mostly through mortgages, with consumer credit accounting for just 10% of banks lending to the sector. But high household debt is a constraint on the UK banks' operating environment. Does that sound familiar? If you like what you've seen here today, please like the post and add a comment or a question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And I want to thank those who have already subscribed. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.